Okay, let's go quickly over overview of chapter 2 again. Chapter 2 is about record business transactions. So in order to record the transaction in the journal, account journal, we have to find out is there actually transaction? Is that transaction involve any of the accounts that we have? Then we're going to put the transactions into the journal. Journal is going to put it into the ledger. Then we're going to prepare this on just a trial balance. Then in chapter 3, we're going to see how we're doing the suggesting entry, prepare the adjusted trial balance, and then we're going to prepare financial statements, journalizing the posting closing entries, and prepare post-closing trial balance. That's where we're supposed to be before the midterm. So in order to do this, we have to set up some rules. We're going to have accounts, we're going to have a journal, we're going to have a ledger, and we're going to have a trial balance. Account is the detailed record of any elements of the financial statements that we're going to keep track of. The accumulation, deductions, and everything like that. Journal is the chronological record of the transactions. We're going to do some journal records today. Ledger is the all the accounts combined together and keep on one place. Trial balance is the list of all the accounts with their balances, either debit, either credit. What's important to know is that we already said that assets always going to be starting with number 1, liability with number 2, owner's equity number 3, and revenue 4. Expenses, for the expenses, we're going to have 5, 6, 7, 8. And when we look at the chart of accounts, either the chart of account that I gave you, assets always going to start with 1, liability with 2, owner's equity with 3, revenue 4, expenses 5, 6, 7, 8. Let me see and let me share one quick chart of account with you. Chart of account, the one that I post for you, it looks like this. So again, all from the basic accounting equation, asset equal to liability and equity. This section here under A is related to the assets. Those are your assets account. They're listed in 2 categories. First is the current asset. We're going to see later when we start talking about the assets, which assets are current. Then we have investments, and then we have a property, plant, and equipment category. Then we have some intangible assets, but we're going to talk about this when the time comes. On this next section is on the other side of the equation, which is for the liability and equity reserved. Liability, again, current liability, long-term liability, equity is just equity. As you can see, assets account start with 1, liability 2, equity with 3. Then we have income statement accounts or accounts which belong to the net income for which you're calculating the income, and we have a revenue account. And then we have expenses. Expenses are listed in 2 categories. First category is cost of the good that we're selling. So we want to see the direct costs of the good that we generate in the sales. And then we have the other operating expense. We can easily put them in the category operating expense, which are expenses for us to run the business. They're still related to the business, but not directly related to the products that we're selling or the goods that we're selling. So knowing that, now it makes more sense which is asset account, which is liability account, which is equity, which is revenue and expenses, and how they are numbered. The other thing is we're going to start doing today double entries, which double entry is going to include 2 accounts at least. at least two accounts included. When one account's going to increase, the other account going to either decrease, either increase. Depends on the account. So how we determine which account increase, which one decrease? Very simple from the chart of accounts. I'm going to go again with the chart of account, and then we're going to go back to the slides here. From the chart of accounts, what I want you to remember is when the sign equal is, we can draw a line. If I draw here a line, let's pretend I draw the line. And what's happened now? That separates this side from that side. And this is only related, this is my balance sheet. Those are the accounts which are related to my balance sheet. And if I draw the line right here, now I separated left side and right side. Now, whatever stays on the left side, as you can see, the normal balance always gonna be debit. Whatever stays on the right side, normal balance always gonna be credit. What that means? That means the asset's always gonna have normal balance debit. Liability and equity always gonna have normal balance credit. The other thing interesting here is that asset, if you want to increase the asset, you can increase it on the debit side and decrease it on the credit side. With the liability and equity is the opposite. Since the normal balance is credit, means that on credit side you can increase it, and on debit side you can decrease it. For the revenue accounts, revenue, what I want you to remember is the revenue is always credit. Of course, there's some exemption, which we're going to talk about those exceptions when the time comes. Expenses account are always debit, always. Unless there's some exemption, but again, we're going to talk about those exceptions. There are always rules and there's exemptions from the rules. That's what I want you to remember now, but when the time comes, I'm going to start giving the exceptions. So let's go back to the slides now. And now the slides are going to make more sense. So again, from the basic accounting equation, assets equal to liability and equity. And left side is debit, right side is credit. That means asset, normal balance is always debit. Liability and equity, normal balance is always credit. If that's the case, assets gonna increase on the debit side and gonna decrease on the credit side, where the liability and equity is gonna increase on the credit side and it's gonna decrease on the debit side. And here's the example. If this person invests $250,000 cash in her business, that means the company is going to receive the cash increasing. And since the person is the owner of the company, her capital is going to increase. So basically, the business now owes money to the owner. That's part of the owner's equity. So the other way you can look at it is this rule for the debit and credit. Again, for the asset, always increase on the debit side, decrease on the credit side. Liability, increase on the credit side, decrease on the debit side. Owner's capital is equity account. The increase on credit, decrease on debit. Withdrawals, that's a special account. That's why the withdrawals account, if you take a look on the chart of the accounts, that withdrawals is listed a little bit separate. Let me find the chart of accounts so I can show it to you. On the chart of account, if you scroll down and see here on the equity section, the second account is owner's withdrawal account. First one is always capital equity. Second one is always withdrawal. And as you see, it's listed in black. And next to it, it says debit. What that means? That means for that specific account, only for that specific account, even though it's an equity account, the normal increase, the normal balance will be debit is going to increase to the debit side. What that means? That means if increasing on debit, that means we're going to reduce the owner's capital. So every time when the owner withdraw money from the company, that's going to start reducing his capital. Withdrawal is going to increase as amount, but that's automatically reducing his capital. On the income statement, revenue increasing on the credit side. That means when the revenue increasing, company generating wealth for the owner, which company owed to the owner, and expenses increasing on the debit side means that now the owner's interest going down. So every time when the company generates expenses, it's reducing the owner's capital, and every time when the company generates revenue, increasing the owner's capital. For the normal balances, we already talked about it. Again, asset account always have a normal balance. Debit, since it's on the left side of the equation, liability and equity, normal balance is always credit. Revenue account, always credit. Expenses, debit. Withdrawal account is debit. Which are the source documents which are going to help? You want to tell us is that transaction or no? There will be invoices. There will be documents from the bank. Now the invoice is going to be invoice of the purchases, in the invoice for the sales. Deposit slip is going to tell us how much money we have received. Bank check is going to indicate how much cash we have paid. We're going to reporting the transactions in the journal. And the journal is going to look, we're going to start today, and you're going to see like on the very left side, there's a date, and then we have a name of account, cash or capital, depends what it is. And then we're going to have two columns for debit and credit. In the middle, we can put a reference, which is going to tell us, is it for the balance sheet, is it for the income statement. Next, that will be the posting reference here in the middle, as you can see. Posting reference, that posting reference can be 1, 2, 3, depends on how you want to number it. For different purposes, different references. Why is done this way? Because the source documents approve the transaction actually happened. So if the auditor comes in the company and I want to see, so the auditor, they're going to see? They're going to see financial statements. And then they're going to ask, okay, I can see the financial statements, but can you show me the transactions? And if you show me the transaction, can you show me the document which actually address this transaction? Because some people, they try to manipulate the financial statements, though, so they just doing debit and credit without any transaction or without any source document. So for that reason, now here on the post reference, as you can see, the post reference is use account number. Now, if you want to put it a little bit more easy for you to understand later, you can even put yourself a description what exactly happened. And once you post everything, it's gonna look something like this. Now, obviously, you're not gonna see it because everything is gonna go to the accounting software, and accounting software is gonna do everything for you. Now, one thing to check, what we're gonna check today, we're gonna prepare this trial balance, and from the trial balance, we're gonna prepare the statements, very simple statements. The trial balance is gonna take a look at the older accounts with the balances under each account. The last thing that I want to tell you is for the mistakes. What's interesting for the mistakes? You have to know how to search for the mistakes. Now, the most common mistake in accounting is transposition error. Omission of the data, yes, no questions about it, but transposition error. And I'm going to show you, let me open one Excel spreadsheet and I'm going to show you the transposition error. what exactly transposition error is, probably you already know that, but let me refresh you on this one. So let me make it bigger, do it this way. So let's pretend that the right number is 578. This is the right number. But you make a mistake. Now the wrong one is 587. So when you look at those numbers and when you make the difference between the right one and the wrong one is 9. So if you see the difference 9 or some number which is divided by 9, that always gonna be tell you that this is transposition error. The number of the digits before the decimal is going to tell you which number are exchanged, first and second number in this case. So if you see number 9, you have to look here somewhere. The other option that you have is uh, 371 and 317. That's another transposition there. Now, as you can see here, the difference is 54. But if you break it down, if I break this down, what I'm gonna see is I'm gonna see that inside I have 5 plus 4, which equals to 9. Again, transposition error. Now, if you want, we can play this game all over again. And you're always gonna see the difference with the number, which is at the end of the day is 9. We can go with the number which is 25,879. And let's go with 28,579. And as you can see here, what we have the numbers which is 2 plus 7 plus 0 plus another 0, which is equal to 9. Transposition error. Right there. I believe you already know about it, how to chase a transposition error. The transposition error usually gonna appear on the trial balance when you have the final numbers, and we can practice. And once we start doing the trial balance, I'll show you how to what will be the indicators that you have a transposition error. That's with the slides. That's why I'm going to stop with the slides here. Again, that's a very informative slides, nothing scary here, nothing that we haven't done before. Last week, if you remember, we went over the different accounts and we talk about which account is debit, which account is credit, what's the normal balance of this account, that account. And the last thing that we did was if we want to increase account, what to do, debit or credit. So let's repeat that one because I want you to remind yourself about those debits and credits and how can I increase the balance, how to reduce the balance. So I'm going to use this question 3, and that will appear on my screen in a second. So once you see this screen, what I want you to do is to think about it. Not payable. Once you see the accounts, you should be able to identify not payable. What kind of account is it? Is it liability? Is it equity? Is it asset account? Does it belong to the revenue or expense? So the note payable is clearly a liability account. What's the normal balance for the liability account then? It's credit, yes. So if I want to increase the note payable, what do we have to do? What's going to give us increase? Debit or credit? That will be credit, yes. Great job, Lena. So for this debit and credit, what I can do is I can leave a little bit space here and I can grab the picture from the slides. Let me find this picture here on the slides and I'm gonna post you this picture. So at least that to remind you for now and you to be able to see it. Yeah, that's the picture. Let me make it a little bit smaller. Here we go. Now we can continue. Now, how about if the account is accounts receivables? What kind of account is this? It's an asset account. Normal balance for the asset is debit. And if I want to decrease asset account with normal balance debit, what should I do? Debit or
Credit.
credit? Credit. Yes, that would be another option you to start speaking up. Strongly encourage. Capital, owner's capital. What kind of account is that?
It's a credit account.
It's a credit account, but also it's an equity account, which normal balance is credit. So if I want to increase the equity account with normal balance credit, I have to put more credit, right? If I add more credit, that is going to increase the balance of that account. If now unearned fees, what kind of account is unearned fees? It's a liability account. Why? Because we get the money, but now we owe the person who pay us, we owe him services or we owe him the money back. Why? Because we haven't done anything yet. So for that reason, it's a liability. Clearly, liability account. Normal balance for the liability is credit. So if I want to decrease this account, I have to do debit. Yes. Next account, prepaid insurance.
Is an
Now that's
asset.
it's an asset account. Why? Because we pay for something that we haven't received yet. Either we have to receive the service, either we have to get our money back. So for that reason, that's an asset. Normal balance is debit. And if I want to decrease it, I have to
Credit it.
credit it. Next account is cash.
Asset.
What kind? Asset, not a liability, right? It's clearly asset account. Normal balance is debit as every asset. And if I want to decrease,
You credit it.
I'm gonna credit it. And we're gonna start credit cash now. It's not my favorite transaction, but what can I do? Utilities expenses. Obviously, that's expenses, right? Expense. And if I want to increase the expense, I have to debit it. Why? Because always on the debit side, increasing the expenses. Next one is fee earn. Fees earned. Once we earn fee, what is that for us?
Revenue.
Revenue. Of course, it's a revenue. And if I want to increase the revenue,
Credit.
credit. Store equipment. It's equipment, right?
It's an asset, so
It's
debit.
an asset. Normal balance is debit, and if I want to increase it, debit. Next one is withdrawals. Now, the withdrawals is equity account, but we say it's a special account. It's equity. Special account, normal balance is debit, and if I want to increase the withdrawal, we have to debit it. Rent payable.
It's a liability.
Liability clearly. And normal balance is credit. And if I want to decrease liability, what do we have to do? Debit. Yes, Lena, you're right. Prepaid rent. We already have one prepaid account above. Now we know that's an asset account. Normal balance is debit. So if I want to decrease that prepaid rent, what do we have to do?
Credit it.
Credit it. Same thing like we did before. Supplies.
Asset, so debit.
Asset. Normal balance is debit, and if I want to increase it, I have to debit it. So imagine, uh, let's put it this way. Grocery, what kind of account is? Asset, liability, or equity?
Asset
Asset. Where do you keep your grocery?
in the cupboard.
In the cupboard. So if you want to increase the grocery, what do you have to do? If you want to increase the balance in the cupboard, what do you have to do?
Go out and buy more.
Go and buy more and put it inside, right? Make sure you don't eat it. You have to make sure that you put it in the cupboard. What's going to happen when when you buy? Let's say you go for bananas. You get the bananas. Now you have the supplies, and or you have the groceries. And in the way to the car, you start eating the banana. What's happened with the banana now? Is it grocery now?
No, it's a grocery expense
Grocery expense. So why is the grocery expense?
because you used it up.
So you start because you start using it for what? For the purpose of the business. What's your business? To live, right? So what you start doing now from the bananas, you start taking the benefits in form of the nutritions, vitamins, whatever you can take, your body can take from that banana. That brings us to the supply expense. If I want to, that's expense, right? If I want to increase that supply expense, what do we have to do? Debit or credit?
Debit.
Debit, of course, debit. Let's put a debit. And the last one is the accounts payable. What kind of account is accounts payable?
Liability.
Liability. Normal balance there is credit, right? So if I want to decrease account with normal balance credit, what do
You
you have to
debit
do?
it.
I have to do the opposite, right? Debit it. If I debit it, the balance gonna go down. Or my liability is gonna get less. All right. Let's do questions now. How do you feel? Do you want to do questions? Yes, no? Are you interested in some questions or no? Nobody says anything, so I don't know what to do. I'm good. Okay, one person is only good. Yes, okay. The other person, okay. So now it's more like I force you to say yes because there's no other options, right? If you say no, what we're gonna do? We just say, okay, let's close the lecture and that's it for today, and you're gonna do it everything by yourself. That's another option. But let's do some questions. What I'm gonna do is I'm gonna show you which question I'm gonna do. I'm gonna grab it, and I want you to grab it too. So I'm gonna go here on the chapter 2. Let me close this one. Let's save this one. So you have the documents under course content, chapter 2. Under chapter 2, when you go to the the chapter 2 practice questions, under practice questions, you're gonna see question 4. That's the question that we're gonna do. Question 4, and I want you to download this Excel spreadsheet. It's gonna look something like this, and download it. I'm also gonna download it so I can have it too. Gonna save it here, and I believe I have the question 4, but just in case I'm gonna download it. Yes, I do have it. Download question 4, and now we can start working with the question 4. So is there anyone from the day class today? Is there anyone in the group here from the day class? I don't see any hands, anything. That's good because the day class, they don't have on Blackboard right now the Excel spreadsheet for question 4, but that's not gonna be the case for a long period of time because I'm just right now gonna post that one. So they can also can have it if they decide to watch this video later today. Some of them. Some of them told me that they're actually watching the video, so here we go, they have that one as well. And I'm gonna replace the question 5 for them because the question 5 I just changed it. Okay, so we're good with this. So with sharing the documents, now let's go to question 4, open the question 4 and start working on the question 4. Now, obviously, I won't be able to share the screen with sideways, so at least I don't know how to have the two screens side by side. I'll try to squeeze them, but I don't think they're gonna show. But what I can do is, or maybe I would be able to do it. Let's just give me a second, and I'm gonna show you what I'm gonna do. I might be able to do it. So first thing first, let me show you what you have on the Excel spreadsheet. Did you guys have a chance to open the Excel spreadsheet? On the Excel spreadsheet, you're gonna have this thing, which is that there's a uh, worksheet with the Excel spreadsheet, the main Excel spreadsheet with the different worksheets on the bottom. The first one is the one that we're gonna work. Second one is the solution. Then we're gonna have the trial balance, the T accounts. Solution for the T accounts. Trial balance, I'm not giving you a solution. We're gonna do it today. And the financial statements, again, we're gonna do it now. So we're gonna start with this part. Now, this part to be easy for me and you to see it. What I'm gonna do, I'm gonna copy it and I'm gonna put it on the Word document right here. And I'm gonna start working with that one. But now I'm gonna be able to share my screen and you can see it side by side. For you, I want you to work on the Excel spreadsheet, if it's possible. That will be a way easy for you. So now you should be able to see my screen. So on one side I have the question, as you can see. On the other side I have the uh, general journal. So I can start working on the general journal. So the date, we know we're gonna forget about date for now. But in Pearson, when you do the questions, you may the question might ask you for date. So please choose the date. So now, one after another. Now this says one, but we have to change it. That's not one anymore. That will be A. So transactions, this company is just opened today or yesterday or March, a few months ago. And the first thing that the owner of the company did is to invest $15,000 cash in the business. How we should look at this? Every time when you see transaction, you should ask yourself what the business get and why the business get it. So what the business gets in this case? Obviously, if the business gets cash. What is cash? Asset, liability, or equity, or revenue or expenses. It's asset, no questions about it. What's the normal balance for the asset? Debit. If I want to increase the asset, what do I have to do? Debit or credit?
Debit.
Debit. So let's go. Debit. Which account I'm going to increase now? Cash. What's going to go in the account? $15,000 cash. So once you do this, what you can do is 15,000. 1, 2, 3. Still give me that headache. So that should be straightforward. I'm going to format those one. You don't have to do this. I'm going to format it so you can see it as a normal amount here. Let me see if it's going to let me to format these cells. Oh, it doesn't give me any options here for formatting. I try to make it as a number, but obviously it's not going to give me. I'm going to leave it as 15,000 like this, 15,000 cash. So why the company get the $15,000 cash? Because the owner invested. When the owner invests cash, what's going to happen? Now he's going to have his own account, right? Owner's account. But now the business going to owe money to the owner. So but that's not going to be liability, that's going to be equity, correct? For the equity, normal balance is credit. So if I want to increase the equity, what do I have to do? Debit or credit? Credit. Let's go credit. And which account we gonna credit? Owner's equity account or capital. Let's go with owner's capital. That seems the right account. And that will be 15,000. So what I want you to do is remember this. When you're doing debit and credit first, the general rule is always keep debit equal to credit. You won't be able to continue if in the accounting software if the debit is not equal to credit. It's going to keep bringing you back until you fix this mistake. Accounting software is going to count it as a mistake. That's one. Second thing, always keep in mind the accounting that you have to keep accounting equation in balance, means asset equal to liability and equity. As long as you remember those two rules, you'll be fine. Let's do the next one. Next one, in letter B, what happened? We purchase furnitures on account. What the business get? Equipment. Okay, the equipment asset. What's the normal balance of the asset? Debit. If I want to increase the asset, what do we have to do? Debit or credit? Debit. Let's go. Debit. Asset or equipment or furnitures. In this, let's stay with furnitures. Why doesn't like it? Furnitures. And how much is the furniture that we purchased? 2000. Credit. We get the furnitures. Now, do we have two options here? Either we're going to have another asset, we're going to give up an asset, which is cash. Either we're going to create a liability, which we have to pay later. What we did here. Did we pay cash? No. Do we have to pay cash? If we didn't pay cash now, do we have to pay later cash? Yes, we do have to pay. So what is that for us? No. We have the equipment, but we haven't paid. What happened? We create a liability. How are we going to go with this liability? Since it's on account, for us, that will be accounts payable. So credit will be account payable. And how much will be that accounts payable we credit? The same amount, 2000. Make sense? Everybody comfortable with this? You understand what happened? We get the asset, we didn't pay for it, but we have to pay later. So since it's on account, it's going to create accounts payable for us. Let's go to letter C. What's happened in letter C? In letter C, we purchase more furnitures, but this time we pay in cash. What are we going to do? How are we going to do this? What the business get? We're going to debit furnitures. For the amount of $500. And what are we going to credit now? We're going to create cash because we paid cash. So cash going to go down. How can I bring down cash? Debit or credit? Credit with 500. Make sense? Let's go to letter D now. What's happened in letter D? We work for customer and we collect cash. What the business get? Cash. So debit is gonna go cash. How much the business get? $1,000. Why did we get that $1,000? Because we provide the services. What will be that for us? I have to credit now something. What will be that for us when we're providing service or work for customer? It's a revenue. Yes, correct. And how much is that revenue? The same amount. Let's go to letter E. And what's happened now with letter E? We did another work for customer, but this time it's on account. Now, did we provide the services? Did we get cash? No. Are we going to get cash? Maybe eventually in the future. So, what's going to be for us? Obviously, I'm not going to debit cash, but I have to debit something. Debit, that will be account receivable. Because maybe the client's going to pay. And the accounts receivable is going to be for $700. And which account we're going to credit? The same thing like before, revenue. For the same amount, 700. Let's go with letter F. What's happened now with letter F? We paid for the furnitures that we didn't pay. So we have to debit something. We purchased the furnitures we didn't pay. We create accounts payable. Now I want to decrease those accounts payable. How can I decrease the accounts payable? Debit. Accounts payable. And how much we paid? $500. And let's pay those one. That will be credit. Which account I'm gonna create? Cash. With $500 credit. Let's go with letter G now. Now letter G. Now we collecting something that happened in letter E. In letter E, what we have? What happened? We provide the revenue, but the client didn't pay. Now the client's gonna pay us. What we gonna collect? Debit cash with $300 and credit accounts receivable. Now we're gonna reduce the accounts receivables with the same amount. And letter H, what's happened now with letter H? Now we did more work for the client, but again on credit. So did this happen, this event happen before? Letter H, is this happened before? Have we worked for the customer and the customer didn't pay us? Yes, in letter E. So what we have to see, one option is to think what happened, the other option is to look at letter E and repeat whatever happened in the letter E. So again, we provide the services to the client didn't pay us. So we have to debit something. Which account we gonna debit? Again, accounts receivable. With how much? With $400 now. And why we debit accounts receivable? Because we provide the service to the client. That will be our revenue for the same amount of $400. So again, since we keep the debit and credit all together, as you can see, debit equal to credit, debit equal to credit, debit equal to credit, we should be all in balance, means the debit is equal to credit in the total. Now, once we have this, let's move to the next step. Next step will be, I'm gonna copy this and I'm gonna move to the next page. but I don't want this page to be here. Let me do some formatting here. I want it side by side. I'll try to make the pages side by side again so you can see it. Let me stretch this a little bit like this. Now should be side by side, yes. So now I have this one, whatever we did. The other thing that I'm going to do is from the Excel spreadsheet, I want you to keep staying on the Excel spreadsheet. I from Excel spreadsheets I'm gonna get the accounts, the T accounts. You don't have to do that because you have the Excel spreadsheet. And let's see if this is gonna work now. So I have the cash, accounts receivable, furnitures, accounts payable, owner's capital, owner's withdrawal, and revenue. Okay, I have everything that I needed. So now I have to start working. So how are we gonna do this? Now we're gonna go transaction by transaction, and every time when we see something related to our account, we're gonna enter the number. Now you can do this on the Excel spreadsheet. You don't have to stay with me on the Word document. For me, it will be harder. For you, should be easier. So first thing first, since this is the brand new company and we haven't done anything at this point, all the beginning balances will be zero. No questions about it. And then starting transaction. The first transaction, letter A. What's happening letter A? The owner invested $15,000 cash. So let's put here the $15,000 cash. That's letter A. And now the debit cash, debit cash. Then we're going to have credit owner's capital. I have to go scroll down, find where the owner's capital is, right here, beginning balance zero, owner's capital, 15,000 credit, 15,000 credit, owner's capital credit, 15,000 going here in this account. And my first record is done. Trying to delete this row and make it a little bit. Let me see. No, it's not gonna let me. Trying to bring it a little bit up, but I'm gonna work a little bit later. So next one, we get the furnitures, letter B. So let's see where the furnitures. The furnitures are right here. So that will be debit furnitures, debit furnitures, and let's put 2000 here. Now, but we didn't pay cash. We create accounts receivables. Sorry, accounts payables. So we have to go to the accounts payable account, which is liability account. Normal balance is credit. So that's why beginning balance always gonna be on the credit side. And what we're gonna do, we're gonna add a letter B on this side, the $2,000. And we are done with this. We have 2,000, 2,000, 15,000 on debit side, 15,000 on credit side. Next one, we get more furnitures, debit furnitures. So let's go debit furnitures, another $500. But in this case, we pay cash, so credit cash. Let's go credit cash, $500 on letter C. Now letter D. Letter D is cash, we get cash, $1,000. Let's get this cash. And why we get cash? Because we're generating revenue. Let's go and record this under the revenue account, which is right here. Letter D, $1,000 revenue. Next one. Letter E, what we get, we created accounts receivables, debit accounts receivables, that's gonna come here. And why we have the accounts receivable? Because we provide the services, but the client didn't pay. So that will be more revenue for us. We're generating more revenue. Unfortunately, we didn't get the cash. We have to wait for the cash. Next one in letter F, we paid for the furnitures that we didn't originally pay. So we pay with cash, so that means in letter F, the cash is gonna go down with 500, but the liability also going down with $500. In the next letter, letter G, we collected the cash from the client who didn't pay us. So we get $300 cash, and the client pay us right here, $300. And is the last transaction is when we provide the service, but the client didn't pay. So we need the more accounts receivable, 400 accounts receivables here, and more revenue for us, 400 here. Now, once we do this, then we going to the accounts. What we have to do? We have to start doing some calculations now. Let's see if this is gonna bring me owner's capital. Almost there. Almost there. Still not enough. Anyway, I'm gonna leave it the way it is. So what we're gonna do? First, we're gonna calculate all the debits. Here we have 15 and 1016 and 300. Now, for you, you can easily just use the Excel spreadsheet and enter the numbers. Just do the calculation on the Excel spreadsheet. I'm gonna enter those numbers. That will be 16,300 here. On the other side, I'm gonna have a $1,000. So the beginning balance plus the total debit here will be, since I don't have the beginning balance, it's gonna be the same amount, 300. Now the total credit is gonna steal the total credit, that's gonna be $1,000. So the ending balance in this case for this account is gonna be beginning balance plus the debit minus the credit is gonna be 15,300 cash left in the company. For accounts receivables, total accounts receivables that we haven't collected is $1,100. We collected $300, so the total collections are $300, and total accounts receivables for us plus the beginning accounts receivables, since the balance is zero, 1,100. So the ending balance in accounts receivables is $800. So what that means? That means the client still owe us $800 for the service that we provided. For the furnitures, it's easy. Beginning balance is zero, so during the period we acquire 2,500 furnitures plus the beginning balance, that's 2,000 or 2,500. On the credit side, we didn't have done anything, so 2,500 is the ending balance for the furnitures. Next account, accounts payable. Now this is a liability account. For the liability account, the accumulation is going to be increase going to be on the credit side, not on the debit side. Debit side is going to reduce it, credit side is going to increase it. So first, for the period, we get $2,000 liability. And during the period, we managed to pay 500 only. Now, since we don't have the beginning balance, our liability will be only the liability we created the period. But since we pay 500, The ending balance for the liability is $1,500. On the capital, the owners invested 15,000. There's no beginning balance, so that will be still gonna be 15,000. And the final balance for us for the owner's equity is $15,000. Withdrawals, there's no withdrawals. The last one left is revenue account, which the revenue account is $2,100. So now once we do this, so the balance here is 2,100. Once we're done with this, what we have to do, we have to transfer the balances of each account that we calculated here into the trial balance. Let me get this trial balance. And you can keep going with the Excel spreadsheet. I'm gonna post the trial balance right here. So you can easily see it and we can work on it. That's our trial balance. On the trial balance, what we're gonna have? We're gonna have all the accounts listed that we have here above with balances debit and credit. First account is cash. And we have what's our balance here? Our balance is $15,300. Debit. Accounts receivables. Do we have anything in accounts receivables? Yes, the client still owes $800, so we can easily record the accounts receivable. $800. So what I'm gonna do here is I'm gonna put them this the way, so it can be at least properly numbered. Then we have furnitures. What's happened with the furnitures? When we calculating the ending balance for the furnitures was $2,500. Then we have accounts payable. And the balance of the accounts payable left is 1,500. Now it's credit balance. Why? Because it's liability. So let's put this one here. 1,500 credit. Then we have the owner's capital, which is also credit balance 15,000 since it's equity. We already know the equity, liability and equity normal balances are credit. So 15,000, 1, 2, 3 here. Withdrawals, there's no withdrawals. That will be clearly zero. And the last account left is the revenue, which is on the credit side. So for the revenue, we're gonna put here $2,100. So once we have those numbers, we can easily calculate the totals. 15,300 plus 800, that's 16,100, plus another 2,000, that's 18,105. That should be $18,600. On the other side, what we're going to have on the other side, if we work correctly, we should get the same number. So 15, 16, 18,600. We have the 18,600 on the credit side as well. So our trial balance is in balance. Now, once I have my trial balance, I can transfer those balances into the financial statements. So let's do that and see what's going to happen. Going to try to push it down a little bit. That's my trial balance. Now let me see if I can bring them all together. So far unsuccessful, but let's try here. I have my trial balance. Now what I'm gonna do is you can still continue working with the Excel spreadsheet. I'm gonna grab this financial statement. I don't think I'll be able to. So for that reason, I'm gonna move to the Excel spreadsheet by only copying this trial balance. Let me share my screen with the Excel spreadsheet now. And let's finish this question. Should be able to see my screen here. And I'm gonna pause this one. Gonna paste it as a picture. No, it doesn't work. So let me grab it again to trial balance here, copy, and let's post it here. Picture. So I have my trial balance. So from the trial balance, what I can see, I can see that I have a revenue. My revenue is $2,100. Now I don't have expenses, so my expenses are zero. So my net income in this case is equal to the revenue minus the expenses. So $2,100 is my net income. Now that net income is gonna flow here, but before we flow here, let's see what's the opening balance for the owner's capital. If you remember, there was nothing. So beginning was zero. Then the owner invested 15,000. So the total became 15,000. He didn't withdraw anything, but the company generated income, as we can see from the top, 2,100. That's going to give us a 2,100 increase in owner's capital. So the new owner's capital in this case is $17,100, which is going to go on the balance sheet as the owner's equity, which is $17,100. Now, what else the business has? The business has cash for $15,300. The business has accounts receivables of 800 to collect from the clients, and with the business has furniture for $2,500. So the total assets the business have are for $18,600. Now, what's happened with those one? We have accounts payable, which accounts payable for us are equal for $1,500. So that's give us total liability the same amount, $1,500. Once we add the owner's equity, which we already calculated from before, 7,100, our total liability and equity is equal to $18,600. Now, let me show you the transposition error. In this case, we in balance. We are all good. But what's going to happen if we made a transposition error? For example, instead of 15,300, I accidentally typed 13,500. Now what's going to happen now? Now I have a discrepancy. So my assets are equal to 16,800 and my liability is equal to 18,600. When I get those two together and find the difference, 16,800 minus 18,600, My difference is $1,800, but $1,800 means to me is equal 1 plus 8 plus 0 plus 0, which is equal to 9. 9 means transposition error. So if you see these two numbers like this sitting one on the asset side, the other on the liability and equity, and they're different, and find out that the difference between them is 1,800 or 2,700 or 9 or 1/8 or any combination of those, which the total comes to 9 when you break it the simple numbers, then that means transposition error. So what you have to look for the flipped numbers. And when we look close, we're going to find out that this number is actually incorrect. It should be 15,300. If we do that, we unbalance. No more transposition error. The other thing that we can do is I can account accounts payable as an asset. Now, what's going to happen in that case? If I put accounts payable 1,500 here and remove it from here, what I did here. I didn't put the formula, didn't I? Let's get rid of this. Let's put the formula here. So now for my calculation, now I have 20,100 as asset and 17,500 100 as a liability and equity. Now, as you can see now, the difference between the two numbers is 3,000. What that means? That means the mistake that we made, it actually double itself. So if you try to look for $3,000 difference, you're never gonna find it. So what you have to do for the number that you're looking for as a difference or mistake, once you see that $3,000 is different, divide it by 2, divide it by 2, and see what's gonna happen. If I divide 3,000 divided by 2, it's gonna be 1,500. Now I can start looking for mistake 1,500. So what's going to happen if you flip liability into the asset account, since you flip it from the credit into the debit, automatically double itself. So the logic is this. Why is double itself? I'm going to explain to you. Imagine this. This is my graph from the seawater level. The seawater level is at level 0, correct? At level 0, that's where the seawater. If we go under, if I go under, I'm gonna below the water. If I go up, I'm above the water. Let's pretend I'm the 2 meters below the water. Now, if I want to go 2 meters above the water, how many meters I need to climb? 2 meters or 4 meters?
4 meters.
So what's happened? The difference is double itself, correct?
Yeah, you have to get back to 0 and then that much
Exactly.
further.
That's exactly what's happened here. When you flip liability into the asset, you're taking the liability, bring it to 0, and then add it to the asset. So that's why the difference double itself. Make sense?
Yes.
Excellent. How do you like this question?
It's good to show where everything goes.
Shall we do one more like this? Yes? At least one person says yes.
Sure.
Two people say yes. Okay, out of how many people we have today? Three people say yes. Out of 17 people, three. Okay, let's do it. You want to take a break before or just jump on the question? So for this is for the question 5, Excel spreadsheet. So what says general journal, this is where you have to put a description of the account, debit or credit, and here the amounts. Now the tricky part here is if I put amount here 5 and it's not equal to the credit, if the amount on the debit is not equal to credit, you're gonna get this message here, debit is not equal to credit. And this message is gonna stay as long as you're not in balance. If once you make it in balance, that should disappear. Not here, should be here, 500, and then the message will disappear. And that's keep going, keep going, keep going. That's one thing. The other thing is, once you make a general journal, then you have to post it on the T accounts. Once you post here something on the T accounts, let's say $500 cash received, automatically all the information is going to fill up on this worksheet T account. Now, if you go to the trial balance, the trial balance also is going to be filled up. If you go to the financial statements also going to be filled up. So this one is kind of interactive Excel spreadsheet. Read one worksheet from another worksheet. So the only information that you have to enter is on the general journal, on the journal and the T accounts. Once you fill the inside the T accounts where the letters are, all the transactions, trial balance is gonna fill up itself, financial statement is gonna fill up itself. So let's go one after another. To make it easy for you, what I'm gonna do is I'm gonna stay on the Excel spreadsheet. I'm gonna copy now the information from the Word document, and I'm gonna post it right here, but this time as a picture. Okay, it doesn't want to post the document. Let me find another way. The other way will be I'm gonna use the snipping tool, and I'm gonna do it through the snipping tool, but before that I'm gonna increase the font of the text so it can be bigger, like this, and then I'm gonna use the snipping tool. I'm gonna post it, and we're gonna eliminating the Microsoft Excel itself. Okay, and now I'm ready to go. Now I can post this one, paste this one here as a picture, not this one. Probably it's gonna be like this. Oh, doesn't let me because the sheet is protected. Now I see why it doesn't let me. To post it, let me think of something. How can I do this? This Excel spreadsheet is protected, that's why it doesn't let me. Mm, I can post it this like as a picture here, but that doesn't help me, does it? You cannot read anything, I cannot read anything. Um, Let me see if I can unprotect this sheet. Because obviously this sheet is protected. Let me see if I can unprotect it. I still remember the password now. Okay, I remember the password, so now I can paste it as a picture. Here we go. Now we have the question and the information all together on one place. So let's go one after another. The first thing, it's a new business. Obviously, it's a brand new business. Open the first time. The owner of the company is going to start first. Always the new business start with investment. The owner, so the company investing. So now the owner can invest cash. The owners can invest some assets as well. It's very common the owners not to invest only cash but also some assets. In this case, let's go letter by letter now. In this case, the owner invested $100,000 cash and office equipment with $9,000 fair value in the new sole proprietorship, which is named Douglas Tax Consulting. On the letter A, so basically what happened is the owner invested something and the owners invested two assets in this case. One asset was definitely the cash. The next one is the office equipment. And since he investing it in the business, that's gonna go to his capital account. So now let's go one after another. Debit. What we gonna debit first? What the business get first? Business get cash. How much cash the business get? $100,000. What else the business get? Debit, office equipment, right? And the value of the office equipment is $9,000. Total of $109,000. Which account we gonna credit now? We have two debits, now we have to credit something. Any suggestion for credit?
Owner's capital.
Owner's capital. With how much? The whole amount, $109,000. And so as you can see, once we're in balance, the message disappear. Let's go with the next one. Letter B. Now what's happened in letter B? In letter B, the business purchase office land and small office building. The land itself worth $115,000 and the building worth $85,000. So let's go one after another. What the business get? Two assets, correct? What's the first asset? Are you guys with me?
Land and the
L-
building.
Debit land and debit building, right? Now we have to put some value. The land value is 115,000 and the building value is 85,000. Total $200,000. Now, how we paid for this? We pay cash 80,000. Let's put the cash credit cash with $80,000. And what else?
Long-term note payable.
Long-term note payable credit. What is this for us? It's a liability,
Liability.
correct? Thank you. Note payable. How much will be that? 120,000. So now, what else we can do is, once we have the journal entry, we can easily go to the T accounts and post this entry into the T accounts. So far we have two entries. Let's do it after each entry. Let's go and post it so we don't forget anything. So on the first entry, what's happened is, let's go to the T account sheet here. And in the T account, first the owner invested 100,000 cash. And he also brought equipment for $9,000. And that goes to his capital account. Let's find his capital account here somewhere. Owner's capital account, letter A, as you can see, $109,000. So that's letter A. 109 on the credit side, 109 on the debit side. For the letter B, now let's get the land first. Here on the land, let's find where the land is. Here, land is 115123. And then we have building, which is office building, 85,123. And we paid cash going down with 80,000. Letter B cash 80,000. And also we have now new liability, which is long-term notes payable for 120,000. Now at this point, if you're curious, we can go to the trial balance and see what's happened with the trial balance. And as you can see, those accounts automatically start to accumulate. Whatever happened here on the balance of the T account as an ending balance automatically start to accumulate on the trial balance. And if we take a look at the financial statements, on the financial statements, we already have some numbers. On the income statement, obviously, there will be nothing because we haven't sold anything to the clients. We don't have any expenses, but the owner put some money, invested capital, which is cash and office equipment, which shows directly in his account. And we can see what the company has at this point. At this point, company has $20,000 cash, $9,000 worth of office equipment, $150,000 land, $85,000 office building. Also, company has a liability, $120,000. So with the assets, when the company pay $120,000 liability for the long-term note payable, the rest is for the owner. 109,000 is for the owner. So at this point, as you can see, the company has more liability than the equity. So let's keep going now. And you're going to see how the information automatically starts updating itself. Now, The company or the business purchase 4,600 office supplies on credit. How are we going to deal with this? What the business get? We have to debit something. Supplies. What kind of supplies? Office supplies. For how much? For $4,600. Did we pay for the office supplies? No, we have to credit something. Did we pay for it? If we pay for it, we can credit cash or reduce the cash. But it says on the credit. What that means? It's on account, right? That will be accounts payable. That will be credit, accounts payable. So we have to pay later. So we create a liability. On the credit side, we increase, so we create a liability for $1,600. Let's go to our T accounts and pause this transaction on the T accounts. Office supplies. Let's find the office supplies account. Office supplies went up with $4,600 and accounts payable went up with $4,600. Now let's go to letter D. Joe Douglas transferred title of his personal automobile to the business. The automobile had valued $9,000 and was to be used exclusively in the business. So what's happened in this case? What the business get? Debit. Are you guys following me? The business get automobile, correct? Let's debit this automobile. For how much? For $9,000. From where the automobile came from? Did we purchase it? No. Did we pay cash for it? No. What's happened? Who bring it? The owner bring it. So if the owner
Owner's
bring the
capital.
owner's capital, thank you. So the owner's capital goes up with another $9,000. Let's transfer these transactions into the T account. So automobile is going to go up with 9,000 and we're going to increase the owner capital with another 9,000. That's letter D. So as you can see now, the owner's capital increased to $118,000. Let's do another one. E, letter E. In letter E, we purchase 3,000 of additional office equipment on credit now. What the business get? Debit. Office equipment. Did we pay for it? Credit. No, we didn't pay, right? But do we have to pay? Yes, somewhere in the future. So that will be account payable. How much we have to pay? $3,000. Let's post letter E in the T accounts. Letter E, we're getting the office equipment. Which office equipment is right here? 3,000 office equipment, and we didn't pay for it, so that means accounts payable is gonna go up with $3,000 on the credit side. So as you can see now, every time when I put on credit on accounts payable, my balance that I have to pay start getting up. going up now. Yes, my assets goes up, but my liability also goes up. Letter F. Now we pay cash wages to an assistant. Now, what's going to happen when we pay wages? What is that for us? Expense now. Finally, we have some expense. Debit, wages expense. And that's for $3,200. And since we paid cash, the cash gonna go down with $3,200. Let's put those in the accounts, see what's gonna happen. Wages expense, so we have to find it somewhere here down. Wages expense, $3,200. Now the expense start going up, climbing up. And cash has to go down, $3,200, because we pay for the wages. And as you can see, before we pay for the wages, we had 20,000. Once we pay 3,200 the wages, our cash left $16,800 cash only. Let's do another one. Letter G. Now in letter G, finally we provide some service to clients and collect $16,000 cash. What the business get? Cash. Let's get debit cash. How much cash the business get? 16,000. Why we get the cash? Because we provide service to our client. For us, that's a revenue. And since the revenue, the only logical thing is credit, let's credit this revenue for $16,000. Now let's transfer this transaction into the T accounts. Let's increase finally our cash, $16,000. And as you can see, the balance now for our cash went up with $32,800. And let's get our revenue. Revenue here is $16,000 revenue. Now revenue starts climbing up. So if we want to see are we okay, if everything going smooth right now, we're going to check the trial balance. Trial balance, as long as the total is equal, debiting is equal to credit, that means we are in balance, everything's perfect. Now you can see those accounts start changing their balances. Now let's check on one more on the financial statement. If I go to financial statement, now I can see up to this point, the business generating revenue of $16,000. We paid for the assistant $3,200. So the business generating $12,800 net income. Who gets the net income? Well, the owner gets it. What else the owner has? His initial investment. So in total, his portion of the business is $130,800. That's his capital. That's how much from the all assets he owes. Now let's see. That's your liability, that's your equity. Where are the assets? Well, the assets we have in cash $32,800, office supplies $4,600, office furnitures of $12,000, land, office building, and automobile, total of $209,000. In total, we have $258,400 assets. From those assets, once we pay accounts payable for 7,600 and the long-term payable, we're gonna have 130,800 left for the owner, so we can pay his capital. Let's keep going with our transactions. Let's see what else is gonna happen with this company. So, next thing, letter H. Now we pay in cash on the month utilities. Debit, utility, expenses, right? For $1,800. And which account what we gonna do? Credit, cash. Yes. $1,800 cash going down. Let's pause this transaction into the T account. So expenses goes up, utility expenses goes up with $1,800, and our cash going down. That's letter H. Let's find the cash for the letter H. Here, letter H, $1,900 cash going down. Oops, $1,800. So at this point, your cash is $31,000. Correct? Are you guys with me? Are you getting the same cash, 31,000, up to this point? Okay, let's go with letter I. Now we sign equipment rental agreement to commence in January. The deposit of $250 must be paid by November 15th. Which month we are? We are in November. What we're gonna do with this? Not applicable. Yeah, that would be the right thing to do. We signed the agreement, which is gonna start in January. Now we have to deposit 250 by December 15th. So at this point, there's nothing, no transaction here, not applicable. And we're gonna move on to the next one. What's the next one? J. Pay cash on accounts payable created in transaction C. Let's see what's happened in C. In transaction C, as you can see, we purchased this office supplies, but we didn't pay. Now we paying. Which account we gonna debit now? Accounts payable. What's gonna happen if we debit accounts payable? Liability is gonna go down. So how much? We're paying the entire balance, 4,600 gone. How will we pay it? Credit? Cash. $4,600. Let's pause this transaction. Now let's see what's going to happen with accounts payable. Accounts payable. Now on the debit side, we're going to put, well, currently we have to pay $7,600. If I put 4,600, if I paid whatever we paid in C, you see my ending balance for the accounts payable left only 3,000. And the 3,000 is the last purchase that I made, which we didn't pay. But now my cash gonna go down with the same amount, $4,600. My cash going down to $26,400. Now let's see in K, what's happened with K. We're gonna purchase $100,000 of new office equipment by paying $10,000 cash. Do we still have cash? We still have 26,400, so we can purchase that equipment. Let's get it. Debit. What the business get? Office equipment, right? For $10,000. And what the business don't have now? Credit, cash. Before we have cash, we don't have equipment. Now we have equipment, we don't have cash. And we convert one asset into another asset. So let's go here and add the office equipment, $10,000, and go to the cash and reduce our cash with $10,000. Sorry, cash, but you're going down to $16,400. Let's go with another one. Letter L. We completed $5,100 service for a client, but this amount will be paid within 30 days. So what we're gonna do? Debit. We provide the service, obviously, but we didn't get the cash. So what's happened now? We're gonna have account receivable with $5,100, and debit will be, sorry, credit. I cannot have two debits. I mean, I can, but not in this case. Credit. Which account are we gonna credit?
Revenue.
Revenue with $5,100. Let's pause this one in the T account. So our accounts receivable is going up $5,100, and our revenue goes up with $5,100. So our revenue right now is $21,100. But we have accounts receivables of $5,100. Let's see what's happening. Letter M. We pay again our assistant. Debit. Obviously, we have to repeat the entry that we did with the wages, right? Wages expenses, which is $3,200. And how are we going to pay our office assistant? Cash. With $3,200. Let's pause this one on our T accounts. We're gonna find this wages expenses, $3,200, and we're gonna reduce our cash with $3,200. As you can see, now our cash is down to $13,200. And the last one, we receive payment for the receivables, which creating transaction L. So out of this 5,100, the client decided to pay us 1,900. Let's get it. What the business get? Debit. Cash. How much the business get? $1,900. Why we get the cash? because the client pay us. Did we provide new service to the client? No. He just paying for whatever he received before, but he didn't pay. So which account I'm going to create now? Accounts receivable. 1,900 dollars. Now let's put this one in the T account. Cash, let's get the cash $1,900 and let's reduce accounts receivables with $1,900. And we're done with all the transactions. Now let's see what's happened. On the T accounts, now we can see and do some analytics. During the period of November, we get $170,900 cash. We pay $102,800 cash, and we have $15,100 cash. Accounts receivables. We still have to collect $3,200 from the client for which we provide the service for $5,100. We have $12,000 office equipment, land, office building, office supplies. We have an automobile. Now, and that's conclude our assets. What else we have? We have accounts payable. Why? Because we still haven't paid for, I believe that was this office equipment here in letter K. No, that's E. Why is the letter E here? Or maybe that's the letter K. Why we didn't pay here? Let me see. What was that letter E? We purchased additional office equipment. Yes, that's additional office equipment that we didn't pay for. The 3,000. What else happened? We have a long-term notes payable, 120,000. We have owner's capital, 108,000. We're generating revenue 21, but we're generating expenses for the wages and utilities. So if you check the trial balance, as you can see, we are in balance. So that means we haven't made any mistakes. Once we're in balance, that's perfect. That's what we want. Now, if you flip to financial statements, now we can start talking to the owner. If the owner asks us, hey, what's happened in November? Am I making money? Yes, you are. How much I'm making? 12,900. What happened with those 12,900? Where they are? They're in your account. What's happened with my account? Well, you invested in the business $118,000 and the business generated for you 12,900. So your capital account right now, you have in your capital account $130,900. Where are those $139,900? Well, there in cash you have 15,100. You have to collect 3,200 from the services that you provided. You have office supplies for 14,600, and you have office equipment for 12,000. Plus, you also have land, building, and automobile. In total, you have assets for 253,900. Well, he's going to ask you, okay, so how come I have 253,900 assets, and you're telling me that only 130,900 is mine? Well, that's because you still have to pay $3,000 for the office equipment, and you have to pay for the long-term notes payable for which we purchase the land and the office building. Once you pay those one with the assets that you have, the rest is yours. Those are the explanation what you have to do. Now, in reality, what's going to happen? Do you have to do everything that we're doing here? In reality, no, you don't have to. But you still have to do debit and credit. That's the only thing that you have to do. Once you do the debit and credit, the software automatically is going to do this calculation for you. And then you're going to run the trial balance. And the software is going to give you the trial balance. After that, now you have two options. Once you've done the trial balance, you have two options. Either you're going to get the trial balance and prepare financial statements by yourself. Either you're going to ask the software to prepare those financial statements for you. Either one works. The good thing is with these financial statements, I purposely make it like a logical, one after another, so you can see the flow of the information. Which one is come first? Which one is second? Why is second? Because we need to draw information from the first one in order to transfer that information for the second one. And which one is the third? Why is the third? Because now this information from the second goes to the third one. And that's how it works. So let me show you now transposition error. Let's pretend, let me see one number here, which is good for the transposition error. Uh, let's pretend that the wages, instead of 3,200, we entered 2,300. I flip the numbers. What's going to happen now? When I check my trial balance, I'll be off balance. Now I have to find out what's the difference. And the difference here, as you can see, 262, 100 minus the 261, 200, the difference is $900. 9 plus 0 equal to 9. Transposition error, right there. So what you have to do, now you have to start checking, which is the number from this information or from this journal, a general journal, which was transferred incorrectly in the T account. And eventually you're going to find that the office wages expenses is flipped number, so it has to be 3,200. Once you make it, your trial balance is correct. Now, what's going to happen if accidentally, instead of debit wages expense, you put it on the credit side? 3,200. So now let's check the trial balance. In the trial balance, now we have a difference. But this wages expenses now it's not, that's not the right thing, because still show 3,200, you should have show you 0. So let's go with another account. Let's go to cash. Cash is a common mistake. Let's go with the, instead of $4,600 credit, we put it $4,600 debit. And this one is nothing. Now let's go to the trial balance. On the trial balance, now I'm gonna have a mistake, right? The two amounts are incorrect. 271,300 minus 262,100. I have $9,200 mistake. Or difference in this case. Difference. Now, if I start looking at the numbers here, do I have 9,200 somewhere? I'm going to find out that I don't have anything Even close. I have 9,000, 9,000, but nothing like a 9,200. If I keep looking for 9,200, I may never find it. And I never gonna find it. And I have to look all day, all day, all day, all day. Nothing's gonna happen. So what you have to remember, maybe instead of debit, you put credit. So how can I find the actual amount that you made a mistake? You have to divide the mistake that you have, or the difference that you have, 9,200 divided by 2. And now you start looking for the number transaction that has 4,600. Okay, 4,600. This is the only place, this is one place that I have 4,600. And is there another place? Yes, there's another 4,600. So what I'm going to do, on the first 4,600, I'm going to go and check office supplies in accounts payable. Do I have those amounts there? So I'm going here, letter C, and I'm checking office supplies, 4,600, accounts payable, 4,600. I'm okay. Next one, I have on letter J, I have accounts payable debit for 4,600 and cash credit 4,600. So I'm going to the T accounts. I have my debit accounts payable 4,600. Let's check now the cash. Oops, instead of credit, I have it on the debit side. So if I put it on the debit side or the credit side where it should be and delete the credit, check my trial balance. Now I'm incorrect. Those are normal, typical mistakes that may happen. You know, in the very beginning, it's super frustrating. I can tell you. So, for example, let's go back to this transposition error, not transposition, but flipping debit to credit. Let's go here. This one and 4,600. The other place, first, the mistake is gonna pop up on the trial balance, and second, when you run the financial statements on the balance sheet, you're not in balance. And how much you're not in balance? Again, $9,200 right away. That's the effect of the mistakes on the trial balance and directly to the final reports. If you want transposition, we can flip this one 6,400, for example, and then right away we're gonna have a mistake here on the trial balance 626,100 minus 260,300, $1,800 mistake. 1 plus 8, 9. Flip number. If you look at the financial statements going to show you the same. Total assets is not equal to the total liability. What's the mistake? It's the same. 253,900 minus 252,100, $1,800. 1 plus 8, 9. You have a transposition error. So now you have to go back to the transactions and try to find out which one is it. And once you fix it, trial balance is in balance, financial statements are in balance, you're ready to submit the financial reports. That's how you're dealing with all those events. Before I let you go, let's quickly go and make a quick review on chapter 3. So we will know what we're going to talk about next time. Very quickly, nothing. I'm not going to spend time on the chapter 3 right now. I'm just going to give you a brief review what we're going to do in chapter 3. Let me open the slides and I'm going to share my screen. What we're gonna do next time? In chapter 3, we're gonna continue with the next part of the transaction. As you can see, at this point, we know how to identify and analyze transaction. We know how to record those transactions on the journal. We transfer it to the T accounts and prepare unadjusted trial balance. We went even one step further, preparation of financial statements. But now, to make it legitimate, we have to go and see, is there any adjusting entries that we have to do and prepare adjusted trial balance. Why do we have to do the adjusting entries? For two reasons, because there's a time difference between transactions and events. Sometimes we may have a transaction, but we may not have a realization. Transaction is when the exchange of the goods and services happen. Realization is when the cash is received. And they may happen at different time. So for that reason, we have to think when the sales actually happens and when the expense actually happen. Is it when we pay it? Or is it when we get the items for the expense or when we provide the service for the revenue? And we're gonna go with the time assumptions. We're gonna talk about the periods. We're gonna talk about the recognition criteria when we're recognizing the revenue and when we're recognizing the expenses. And we're gonna see that recognition versus realizations are two different events. We're gonna see that two types of accounting, which is cash-based accounting. So every time when the cash is exchanged, that triggers the journal entry. And we're going to see the accrual basis accounting. When we provide the services, but we don't receive the cash. And what we did today, we debit accounts receivable. We're not saying, okay, no, there's no transaction here. No, there's a transaction. But we're going to do something else. And we're going to talk about the adjusting entries and what we need to adjust. There are some accounts that has to be adjusted at the end of the period. Why? Because of the timing. For that reason, we're going to talk about adjusting entries. And we have two main categories adjusting entries. There are three types of adjusting entry. Two of them are, one is prepaid deferral, and the other one is accrual. And we're going to see what's the difference between the deferral and accrual. We're going to talk about prepaid expenses, prepaid insurance. What's interesting with those prepaid expenses? When prepaid expense gonna become expense, when the prepaid insurance gonna become actual insurance expense, where the prepaid rent's gonna become a rent expense. Then we're gonna talk about amortization, and we're gonna see that the assets, once we use the assets, they reducing their value. And we're gonna see how much each year the value is reduced and why it's reduced. Then we're going to talk about the unearned revenue and what's happened when we earn the revenue. Obviously, we have to move it from unearned revenue into revenue when actually the unearned revenue become earned revenue. We're going to see how we're going to do this. And we're going to do some accruals. Accruals is something that we know is going to happen and but we haven't paid yet, or we owe the money for somebody and we have to pay later, or we have to receive cash, but we have to show the receivable right now. Those will be the accruals. And once we move to accruals, we're going to see the summary of all the adjusting accounting entries. So there are three type of accounting entry. One is the deferrals. The other one is for the accruals. and third one is for the amortization. We're going to do some exercises. We're going to prepare this adjusted trial balance. So the adjusted was will be the difference between the trial balance that we did today and adjusted trial balance. You're going to have new information available. Based on that information, we have to do some adjustments on the accounts, and that's going to change a little bit the adjusted trial balance. Once we have this adjusted trial balance, now we can start prepare the statements the way we saw it today. First, we're going to start with the income statement, and we're going to see the links between the income statement. Net income is going to flow to the shareholders' equity account, and we're going to prepare the statement of shareholders' equity, which is going to start with the capital at the beginning of the period plus the net income less the withdrawal is going to give you capital at the end of the period. Here, we may also have additional investment from the owner. In this case, we don't. And we're going to see that that capital account is going to go under the equity section under capital. And then we have to prepare the other part of the financial statement. There will be some ethical concerns about those adjusting entries at the end of the period, because that's where the game is in accounting. At the end of the period, when we're doing the adjusting entries, that's actually the interesting part. Where are the opportunities you to deviate from the reality? And we're going to see how we're going to fix the mistakes if we did something that we're not supposed to do, and how exactly we're going to fix it. And that's what we're going to do next time. Then we're going to practice a little bit, and then we're going to do chapter 4.